The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A bond sell-off, a stock sell-off, a sell-off in the dollar, and a lot of questions about the Fed's credibility. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Emily Grafeo. We're kicking you off to the closing bell here in the U.S. And let's take a look at how markets are moving right now on this Fed day. We have the S&P 500 lower by about 1.3%. Tech stocks getting hit as well, down about 1.7% on the NASDAQ 100. But a lot of the focus here on the bond market and the steepening in the yield curve underway right now. We have the 2-year yield down about 6 basis points now, and the 30-year yield at one point hitting its highest level since 2007, climbing above 5.2%. Right now, it's up about 10 basis points.
Yeah, normally I don't make too much of these knee-jerk reactions on Fed days, but this seems a little bit different. We should point out that the price action after the initial FOMC statement at 2 p.m. was relatively muted. And even when Kevin Warsh first began speaking at 2:30, also relatively muted. But the more he spoke, well, it seemed like the worst things got here. Of course, a lot of people really wanted to know not so much when they would hike, but just what the commitment the FOMC, led by Kevin Warsh, would have to fighting inflation. And he made it clear that he would not be soft on inflation. But as you can see, particularly in that disparity between the 2-year and the 30-year yield, not a lot of folks are buying it. Here's what Kevin Warsh had to say.
Let me reiterate. There is no soft inflation target. There is no soft implicit target, not on this committee's watch. CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. I asked for a good family fight and I got one. I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. In the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic.
Kevin Warsh, your Fed chair, second meeting, of course, that he's presided over in a market now at odds with what they heard. Ken Shinoda joins us right now, DoubleLine Capital Portfolio Manager. And let's talk about the moves that we are seeing today in yields. That big bump up in the 30-year yield, 5.2%, highest that we've seen since '07. The 2-year drops, a steepening of the curve on the 2-10s, up about 16, 17 basis points right now, Ken. What is the market trying to say?
Well, I think Warsh was a little bit more dovish than people expected, which is why you're seeing a rally on the 2-year, and the long bond doesn't like it. The long bond doesn't like that they're not fighting inflation. There was a lot of reporters that kept asking him, if you're so adamant about getting us to 2% and there's no soft inflation target, then why are you not doing anything? He didn't really have a good answer for them.
Well, it gets to this idea, too, Ken, and I don't want to make too much of the dissents and all the things that go on behind the scenes, but you had the 3 dissents today. The consensus had always been that you might actually see more, even coming into today, that you would see more at the next meeting in September. Do you think there's any potential pushback, not so much just from the market, but from some of the other FOMC members to actually take this a little more seriously?
No, I don't think so. I think what they're looking at is that they want to see some more inflation prints. They want to see if there's any type of resolution in the Middle East, which is going to be challenging. And then, they've got these committees that are supposed to be meeting and talking. And I guess he wants the results for that. But I think the challenge is going to be that the market wants hikes. The market wants fighting of inflation. Stocks are down meaningfully now after this move.
What do you make then of the move lower in the 2-year yield? Because Warsh was talking a lot about how a lot of the rate move higher has kind of tightened financial conditions for the Fed. Is the reaction in markets today actually kind of undoing some of that work?
Yeah, a little bit, but just think about long-term rates. New high since '07 on the long bond. You're going to have mortgage rates kissing 7%. So the cost of capital is definitely higher for borrowers and for corporate borrowers. The high yield market yields are higher. So there's definitely been some tightening of financial conditions, which I think is one of the reasons they didn't move today. But if time passes and we don't see any, energy prices come down and a resolution in the Middle East, I think they're going to have to hike later this year.
Well, I mean, are conditions tight, though, Ken? I mean, I know this has been a debate for a while now, but I mean, when you look at where yields are now, real yields at least, are right now, some would actually make the argument that conditions aren't necessarily that tight.
Well, if you look at the corporate bond market, spreads for riskier stuff are going wider. So the market is starting to sniff out some issues, especially in tech, AI, hyperscaler type parts of the market. There's a company we follow, CoreWeave, that's a public company that's involved in the data center market. You know, their bonds are down 15 points from the middle of June, trading in the teens now. So there's some problems brewing in the credit markets. So cost of capital is going up.
Well, I'm curious about that, and we should just point out to our viewers, we're going to be talking a lot less about the Fed in a few moments because we're going to hear from big hyperscaler in Microsoft and a wannabe hyperscaler in Meta, not to mention Qualcomm ARM, also scheduled to report after the bell. And Warsh was asked about some of this CapEx spending, and he kind of talked about this idea, hey, this is a bet on future growth. But we were talking about this on the show yesterday, Emily and I, looking at the CDS market, and you're now starting to see something I hadn't seen in recent months, and that's real material hedging going on right now in the credit market.
Absolutely. I mean, some of these companies that are investment grade, like Oracle, their spreads are like double Bs now. And so I think you're seeing into the equity market started maybe a month or so ago. This whole year we've seen weakness in kind of like Mag 7. Now you're seeing the semiconductor index kind of drop. And that same theme of like maybe they're not going to make as much money as they hoped on all this CapEx. They're starting to worry about it in the debt markets. And so I think that's something, a continued theme to follow and watch and be aware of as investors.
What does that mean then, Ken, for portfolio positioning, where you want to be along the curve? Is it now time to just go all in on the shorter end?
We like the shorter end of the curve. We're also pretty negative on the long end. We think there's a risk that keeps steepening, especially with all the government spending that's coming down the pipeline, Social Security. I mean, there's all this talks of we're running out of missiles. They're gonna need to spend money on defense spending, and they're gonna have to give something to the Democrats. So there could be more debt coming down the pipeline. That should be bad for the long end. As far as portfolio positioning, I think investors really need to know what's in their credit portfolios. As more of this tech and AI come into the corporate bond market, correlations are going to increase with equities, and everyone's long tech in their equity portfolios. So we've been very hesitant to add exposure to this kind of hyperscaler and data center debt. We have very little exposure there, and I think that's going to turn out to be a good thing for us here at DoubleLine.
Well, then what provides sort of a more natural hedge right now for maybe those folks that did jump into the pool with regards to the AI bond sales? Is there a natural hedge out there that you would look to if you were in that position?
Yeah, I mean, look, every name is not bad. We buy some bonds in that space as well. We just try to limit it into our portfolios. But go back to basics: short treasuries, agency mortgage-backed securities that don't really have any AI risk other than maybe prepayments speed up. If we can get, we don't have to sign 50 pages with a notary to get our mortgage refied. And then parts of the securitized markets, residential mortgages, non-agencies, CMBS. Asset-backed securities backed by credit cards and auto loans and hard assets. I mean, these are all sorts of sectors you can go into that don't really have anything to do with the big CapEx going on in that data center market.
Ken, always a pleasure. Ken Shinoda, portfolio manager over at DoubleLine Capital, one of the best in the business as we count you down to the closing bells. And Emily, stocks right now hitting session lows with the S&P down about 1.5%. It looks like the NASDAQ 100 will close down 10% from its all-time high, so technically correction territory. And I guess sentiment could maybe worsen or maybe improve depending on the outcome of some big earnings we're going to get after the bell, including from Microsoft and Meta. Yeah,
I mean, it's turning out to be a very volatile regular trading session, and that's not even counting what's going to happen after this closing bell. I'm just watching that bond market. The steepening here, Romaine, really incredible to see. There wasn't much of a reaction in rates right after the Fed decision came out, but now you look at the curve and that 30-year just crossing 5.2%. Incredible to see.
And on that 230s, as far as that steepening, we see about 16.5 basis points, the most extreme steepening that we've seen in about a year here, a market, at least in the bond space, making it very, very clear that it does not take the words of Kevin Warsh today to heart. Now, whether the equity market can reconcile with that and reconcile with what we're about to learn with regards to the CapEx spend coming out of the hyperscalers will be seen. The closing bells in New York on the day. A Dow Jones Industrial Average down more than 1,000 points or 2% on the day. The S&P losing about 112 points or 1.5%. The NASDAQ Composite down 1.7%. The NASDAQ 100 is going to close lower by 2%, down about 571 points. That's down about now almost 11% from its all-time high back in early June. So that is correction territory. The Russell 2000 lower by 1.6%, and Dow Transport's going to close out the day down about 1.9%. We have several consequential earnings, about a dozen that are going to come after the bell tonight, and the first one has arrived, and that is from Qualcomm. The results are in for its fiscal third quarter. EPS in line with estimates at $2.21 a share. On the revenue side, it does appear they are slightly above estimates at $9.95 billion. The street was looking for $9.62, but the guidance, take heed here. Fourth quarter revenue, 9.7 to 10.5, a wide range. The low end of that range is slightly below the average of street estimates of 9.95, but obviously a little bit more headroom to the upside of that range. On the CapEx front, the company says, well, actually, let's hold off on that number for right now. As far as the revenue for the quarter, we talked about that 9.7 number. Adjusted EPS 2.05 to 2.25. The street was looking for 2.35, so that would be a slight miss as well. And handset revenue, it was down, and that was expected to be down, though not quite as down as much as people thought, Emily. And then here is a number that a lot of people are looking for. For the fiscal year 2029, non-handset revenue for Qualcomm is going to be $40 billion. That's up from a previous projection of $22 billion for 2024. So an interesting comparison there as the company tries to transition away from just being a handset provider of handset chips and more to that AI ecosystem.
And we do have that stock moving already in after hours. Qualcomm down now 4%. We saw a little bit of a pop right after the earnings, but the story right now is that stock is in the red.
All right. We're going to bring in Mandeep Singh, our global technology leader, in just a second. Mandeep Singh sitting right beside me. Before we get to Mandeep, Meta now crossing the wire. I believe Microsoft also crossing the wire as well. Let's get straight to the Meta numbers. Here's your forecast for the third quarter, the current quarter that we're in. The company says expects $61 to $64 billion in revenue. The street was looking for 63.17. That is the red head. On CapEx, Meta saying that for the full year, $130 to $145 billion. The previous guidance was 125 to 145. So really keeping the top end of that CapEx spend where it was at about 145 billion, nudging up the lower end of that to 130 from 125. As for the numbers, and we'll walk through some of the numbers for the current quarter, it does look like they were relatively in line to slightly above estimates all around. But Emily, let's get straight to Microsoft as well.
Yeah, when you look at Microsoft fourth quarter revenue, beating estimates here at $90 billion, just about estimates of $87 billion. They also reported a $3.2 billion gain from their Anthropic investment, Romain, in the fourth quarter. The fourth quarter Azure and other cloud revenue ex-currency did beat estimates.
Let's bring in Mandeep Singh, Bloomberg Intelligence. I want to get your snap reaction first on the Meta numbers. A lot of people were focused on that CapEx number. A lot of people thought they were going to raise it. They didn't.
They did not. And look, the memory prices is what accounted for the prior increase. So it feels like they feel good about the memory price impact in the second half. And you have to remember the CapEx for Meta is going to be second half loaded. They spend like $19 billion in CapEx in 1Q. So from that perspective, given it's back end loaded, it seems like they are handling that supply chain aspect well when it comes to just the data center spend. And the top line view was slightly on the lighter side. And I'm guessing because the comps get tougher for them in the second half, they want to be conservative here.
Let's take a look at Microsoft, having the opposite reaction as far as the shares. The shares are up here. Emily read out the numbers, a beat. The Azure business doing great, 43% growth there, above what the street was looking for. And another redhead crossing the wire saying that his 365 Copilot reached 30 million paid seats. Is that good or bad? I don't know.
It is good
Yeah.
because the prior number was, I think, around 20 million. So from that perspective, the bundling strategy that Microsoft has continues to work. It's more the usage. That's where the concern is when it comes to the Copilot usage relative to, Anthropic and ChatGPT. And that's where I'm sure they will give more color. But there's no doubt on the top line, this is a very nice beat. And the Azure number, everyone was hoping they would sequentially go up after the Google print we saw last week. So from that perspective, it's good news.
In conversation with Mandeep Singh over at Bloomberg Intelligence, ARM Holdings also out with earnings, another chip maker with a big focus on handsets and automotives. The 1Q numbers, a beat, adjusted EPS 45 cents. Emily, the street was looking for 40 cents. Revenue also coming in above estimates, and the guidance for the current quarter that we're in. The company says expect revenue of 1.33 to 1.43 billion. The street on average was looking for 1.35.
And that second quarter forecast for adjusted EPS remained for ARM. They do see adjusted EPS 43 cents to 51 cents versus estimates of 45 cents. So at least right in the middle of the range here, slightly positive for ARM. We are seeing those shares up about 2% in the after hours. Mandeep, your reaction?
Look, right now, if you have exposure on the data center side, and ARM does have, a big exposure with the, ARM format being used across all of NVIDIA's GPUs and CPUs going forward. So from that perspective, I'm not surprised they had a better print, but there's no doubt that smartphones will be a drag on pretty much every company this quarter. We saw that in Qualcomm's print, even though the guide was better in terms of diversifying their revenue line. But it'll be interesting to see what this means for Apple, given what we have seen today in terms of smartphones.
All right, hold that thought. Still in conversation with Mandeep Singh. We're now getting earnings outside of the tech space now from Starbucks here, and the guidance catching a lot of people by surprise. The company says, not the guidance, for the quarter, 3Q comp sales coming in at about 7.9%. The street was looking for 5.7%. And of course, this is a company that has put together a string of comp sales growth numbers that continues to get higher. And there were a lot of questions as to whether they could continue to do that. They did that for the third quarter, and the company says that for the fourth quarter, expect that to continue. On a sequential basis, it will be slightly lower, but it will still be 6.5%. The street was looking for 4.8%. The share's up about 7% now in the after-hours trade. We'll get back to Starbucks in a moment, but we do want to go back to the tech space here as we are still with Mandeep Singh of Bloomberg Intelligence. And I do want to go back to Meta and kind of where they kind of fit into this AI ecosystem. The share is under pressure. And we should point out, coming into today, I think they were down for like 9 or 10 straight days or something. Yeah, their longest daily losing streak ever since they went public. Why aren't investors kind of warming up a little bit more to what Zuckerberg has been trying to communicate about Meta's role in the AI universe?
Look, even though they haven't raised the CapEx guide, but $140 billion of CapEx for, not really outlining how incremental it will be to top line. I think that's the concern here is you don't have a cloud business. There is no backlog number. And I think they will talk about either the compute rental side or their own model, how they plan to monetize. So those are the details I think we'll find out during the earnings call.
Before we let you go, what are you looking for when it comes to Microsoft CapEx?
Microsoft has a backlog number. I haven't seen how much they grew backlog, but they are overly exposed to OpenAI when it comes to that backlog growth. And right now, OpenAI is involved with a lot of companies in terms of, the backlog aspect. So it'll be interesting to see how Microsoft is talking about how much of that backlog will translate into revenue over the next 1 year. I think near term is what's more important for Microsoft.
Mandeep, always appreciated. Mandeep Singh over at Bloomberg Intelligence, who helps to lead our technology coverage. Meta Platforms down about 5% in the after-hours trade. Microsoft up about 3%. A slew of other earnings that we're going to get to as well over the next hour, including from Qualcomm. Those shares are lower. Carvana just out. Those shares plunging 19% in the after-hours trade. And if you're looking for an upside right now, you're going to find that in Starbucks, believe it or not, up 8% in the after-hours trade. We'll be back in a moment, right here on The Close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Emily Grafeo.
And I'm Romaine Bostic. Ugly day in the cash session for major U.S. equities. The S&P down 1.5%. A lot of hay is going to be made over the NASDAQ 100, which dropped 2%, but more importantly now dropped below that 10% threshold from its all-time high. So if you're one of those believers, that is technically correction territory. The Philadelphia Semiconductor Index, it's past correction territory, deep into bear market territory, adding another 5% drop here on the day. But of course, Emily, a lot of talk earlier in the day was about what we saw with regards to those big move in interest rates, and more importantly, the disparity, that big bump up in the 30-year yield, 12 to 13 basis points, while the 2-year yield dropping about 5 basis points, the biggest steepening that we've seen on the 230 curve in about 1 year. But of course, right now, a lot of folks now focused on those tech earnings.
Yeah, let's take a look at some of those earnings movers in the after hours right now. Microsoft in the green, up about 1%, but it is bouncing around a lot. Of course, this is after the company results showed strong cloud revenue. It was a revenue beat. Meta's a different story. That stock down about 4% in the after hours. They boosted the low end of their annual CapEx spending forecast, and they gave a lackluster third quarter revenue forecast. So the focus really in this earnings season, how much are these companies going to spend, and is it actually going to pay off?
Absolutely. And of course, a big part of that story is, well, do they need to borrow to continue to do it? That's probably a big part of the reason why there was some concern about Meta coming into this print, $145 billion. That was effectively what they said they might spend on CapEx. They maintained the top end of that range, bumped up the lower end of that range ever so slightly. We're going to have to wait a little bit longer to get Microsoft's outlook, as they generally hold off on that until the conference call. Alexandra Wilson-Elizondo joins us right now, Global Co-Head of Multi-Asset Solutions at Goldman Sachs Asset Management. And I do want to start there, Alexandra, with kind of the borrowing binge that we've seen. Most of these companies, and we should just to be fair, are in good shape. They are profitable. Up until the most recent quarters, they had positive free cash flow and pretty healthy free cash flow. But there is a lot of concern about the amount of money that they need to fund their AI dreams. And just how much they're going to actually have to pay for that, which, at least based on the reaction in the bond market today, they're going to be paying a lot more for it if this sticks.
Yeah, the cost of capital has definitely gone up. Most models have assumed that the cost of capital for the issuance is around 6 to 8%. But as you've noted, the 30-year Treasury is up about 11 basis points. A lot of them have been issuing long debt. But holistically, the market has just been punishing the hyperscalers this month. And, some of the Momo high beta names are down 30+%. There's a lot of emphasis on, not just the spend and the forward of AI, but who's actually going to start to see the real ROI and be the beneficiary at this point.
Well, that's my question. I mean, despite some of the dourness that we're seeing in the moment right now, is there a sense that if we do soon start to see some of these companies actually articulate that return, or at least a vision for when that return is going to show up, do you think that would shift sentiment, or are we too far gone already?
No, I think there's plenty of space for that. But, right now the market is focused on, we have a Fed that's very, in specifically today, not giving a lot of clarity. A lot of clarity, focused on data dependence. That creates more volatility in the rate market, hurts the ability to issue or to understand what the issuance return will ultimately be, and that's what the market's just kind of focused on right now. But that doesn't mean that it's a long-term, trajectory or an indictment on AI names holistically.
How do you approach, from a multi-asset perspective, then, investing in the AI boom? Because, some people say if you're really bullish on AI, you should just go all in on the equity and avoid the debt. But of course, these companies are really coming out and they're issuing a ton of paper right now. Do you avoid the debt? Do you go all equity?
No, I mean, there's a lot of really interesting things coming to the corporate bond market. You just have to be able to do your work. You have to know the asset. You have to know who owns the underlying risk. But some high quality names coming, 6.5%, 7.5%. That's really good income, especially if you have a big income portfolio that you're trying to manage to.
Well, I am curious, so if I jump in, because I am curious about that, because, I mean, even if you start to think about the potential stress, financing stress out there, there is sort of this idea that these aren't the types of companies where you're probably going to be facing any sort of payback risk, true payback risk. And there may be some strain there. So it's worth locking in if you can get some of those rates that you just mentioned. You think that's worth it?
I mean, again, you have to do your work on the issuer, and who what the underlying asset actually looks like and what it could be used for over the long period of time. But yeah, especially on the front end of the curve, anything 5-year, that has 100, 150 spread on it, that's pretty attractive to us.
Do you think we're going to see more new issues that are shorter dated because the rate picture now looks like rates are going to be higher?
Yeah, potentially. I mean, right now, the market is telling you that Fed credibility, the clock is ticking, right? So you saw the dollar move, break-evens moved, the curve steepened out. And so, with that comes, hey, what's the best and most optimal place to issue on the curve from here?
Were you surprised by kind of what transpired today? Because it seemed coming in, everybody was talking about this idea that this was the moment for Kevin Warsh to sort of assert some credibility with regards to the fight against inflation. And he said that. I mean, the words came out of his mouth that they didn't raise, but no one really was expecting, other than maybe a small group of people, a raise. But why don't you think that the market was a little bit more receptive to his message? What was I missing there in between the lines?
Yeah, it was really about the delivery. So everyone understands that he doesn't want to, forecast what the next, data point is going to look like, and he wants the market to do what it's supposed to do, which is find its clearing rate. That being said, there wasn't really a mental framework that was sufficiently provided as to how they're going to be thinking about this on a go forward, and that's really what put the credibility, in question. Again, we think that September is still very much so in play. We have a lot of data to get through. In order to think that they're not going to do something, you have to have a pretty consistent view on inflation for every single print that you're going to see. That doesn't mean they're necessarily going to hike, but it's still on the table in our minds.
That's what I wanted to ask you. What do you think Warsh would have to see now in the data to not hike in September?
Well, you'd have to see, continued improvement in inflation. Perhaps the labor market would have to change. I mean, he's been pretty clear about what he's, being thoughtful around, but he's leaning a lot more in terms of inflation over the labor market.
Right.
And that was pretty clear in this statement, but just in the questions and the responses to the questions, it led to
Yeah, I think that's why I got a little confused, because that seemed more definitive than in the past. They seemed almost before trying to make the argument that, okay, economy is strong, labor market's strong, and thus, we can do whatever the heck we want. But we're going to get another inflation peak tomorrow, and I know month to month these numbers can fluctuate, but we're going to get the PCE numbers here. There was a lot of hay made over the CPI and PPI numbers that we got that were softer than expected. I know that might have just been a one-off, but is there a case to be made that while inflation may not necessarily be trending down at 2%, is not necessarily, on some sort of, trajectory upward longer term?
Yes, I mean, what complicates it is obviously what's happening in the Middle East and oil prices. That being said, he is focused on that these are supply side dynamics, and it's not the demand side that's driving inflation. And it's one of the reasons he thinks rate hikes are perhaps less effective, and the emphasis is not on hiking right now. And he's buying himself some time, really building out these task forces who are supposed to dig down into some of the dynamics of what is this very new and interesting economy.
I am curious about positioning in the equity market. If we do see kind of what we're seeing played out in the bond market today, if that does stick, does that actually make, to a certain extent, equities, maybe take out some of the hyperscalers and AI companies, but does that make equities in general a little bit more attractive?
Well, it depends, right? Because if you're a long duration asset and you've got a higher discount rate on the back end, it obviously competes with that a little bit. But that being said, we still think that the AI story and the beneficiaries are starting to really show through in terms of some of the efficiencies. That's why banks and financials are doing so well. That's why healthcare is as well. So it's really, for us, this is like not just buy the whole index, but really a lot of active management in your selections.
What about the rotation? People have been talking about the rotation for too long. If you haven't rotated already, is it too late? RSP, the equal weight ETF, is already at an all-time high.
Yeah, it is. I mean, it's not necessarily too late. There's still a lot of momentum behind these names, and you've seen some pretty strong earnings even this afternoon. But, and in some cases, certain markets in Asia have already washed out pretty significantly. So there's an opportunity to be taking a look there. They're trading, 5 times at this point.
Gosh, yeah.
Just a little bit of caution around the levered community, levered retail trades, and that's something we've been, spending a lot of time and effort on.
Thank you so much for joining us on this Fed Day, on this earnings day. That was Alexandra Wilson-Elizondo, Global Co-Head of Multi-Asset Solutions in Goldman Sachs Asset Management. Now let's just take a look at shares of Microsoft out with earnings moments ago. Investors most interested in those revenue numbers, particularly from the Azure and the cloud business. Joining us live is Rishi Jaluria, Managing Director of Software Equity Research at RBC Capital Markets. Let's just start with your top line reaction to these results.
Yeah, look, thanks so much for having me. Look, I think these were fantastic results. Obviously, we're going to wait and see on the guide. We're going to wait and see on CapEx and commentary there. But they crushed Azure. I think people were expecting a 40% number, and they did 43% constant currency. You actually had CapEx be a little lighter than maybe feared in the quarter, and we'll see how they guide CapEx for FY27. And one thing that maybe got hidden in a lot of this is their Office Copilot numbers. They had record Office Copilot ads. They added 10 million Office Copilot users this quarter, which is double the amount they added last quarter. So far, all around, I think seems like a very strong quarter to me. A little surprised by the muted reaction, but we'll see how the call goes.
Yeah, what do you make of just Microsoft's approach to CapEx? I know we're going to hear more in the call, but last quarter, they said they expected to spend roughly, $190 billion in CapEx in the year, but we didn't see a ton of that spending already. What do you make of that strategy as it compares to the other hyperscalers?
Yeah, look, I think they're going after the strategy. They recognize they made a mistake in the past by kind of pumping the brakes on CapEx, and they lost some incremental business or had to work with third-party vendors as a result. And so I think they're going to err on the side of overbuilding versus underbuilding, especially because they have the ability to bring all that third-party capacity back in-house. It might be kind of a seasonality piece of why maybe CapEx was a little bit lighter than we would have expected, but we're watching very closely what CapEx for FY27 will look like. I think the street's at 190. I'm at 230 billion, fully burdened, including capital leases. So we'll see where they kind of end up. But I think we're going to see very high growth in CapEx for next year.
Well, yeah, and it's kind of interesting, too, and I'd be curious to see when we get to the conference call how much they're willing to put their cards on the table. But when we talk about the annualized pace that we've seen, even with the slight miss today or missed expectations on the downside, you're still tracking in that $190 to $200 billion range, if that actually sticks here. Is there a case to be made, though, about when we talk about the computing capacity and all the things of how this all folds into Azure and beyond, that even if there isn't this sort of holy grail of AI ROI that everybody's looking for, that for Microsoft specifically as a company, this works out in their favor one way or the other?
I think that's exactly right. They have enough stock gaps and the like that they're in a good situation that if we ever hit a point of which we collectively have overbuilt capacity, and I think everyone's expecting that to happen at some point. That's what happens when the largest hyperscalers are spending combined the GDP of Sweden, and maybe that number is going to go even higher on physical CapEx. At some point, we will overbuild. And I think with Microsoft, because remember, they have so many third-party cloud deals with OCI, with CoreWeave, with Nebius, with a lot of others. They have expressed publicly their desire to bring that back all in-house over time. And so if we ever hit that point, I would expect to see more of that third-party capacity going back in-house. Not to mention, a lot of the capacity they're building out is not just to support Azure, as you kind of hinted at, but it's to support these first-party AI applications, whether it's GitHub Copilot, Office Copilot, Security Copilot, and there's a lot more to come. So I think Microsoft is in a unique position from that vantage point.
They got an interesting boost in the quarter, obviously, from their investment in OpenAI. I'm curious, I don't want it to be too loaded of a question, but does their investment and relationship with OpenAI at any point in your view become a little bit more of a liability and less additive to their bottom line?
Yeah, look, I think the point at which it was viewed as a liability was maybe 3-4 months ago, but you've seen them work very closely with Anthropic as well. And in fact, that was one of the reasons you saw kind of a one-time beat on EPS. Even stripping that out, they still would have beaten in the quarter. But, the Anthropic market valuation has been marked up. But I think importantly, Microsoft has embraced multimodality. They've built all their AI applications in such a manner that it can work with OpenAI and Anthropic and open source and whatever have you. And they're definitely leaning into that. I mean, you've seen Satya really embrace the concept of distillation, embrace the concept of multimodality, especially as we're going through this era where enterprises are trying to figure out how do they, maximize their token budgets, after we were kind of going through that era of token maxing where things were kind of off the charts. At the same time, they do still have the perpetual right, or not perpetual, but until 2032, the IP rights to OpenAI, which means that they can build their own fine-tuned or domain-specific models, leveraging that and not have to eat the margin, not have to spend additional CapEx for specifically that model development. And I think that puts them in a really good position from a model standpoint, that they don't have to have their own frontier model, because to a certain extent, OpenAI is their frontier model.
You know, speaking of enterprise budgets, Microsoft 365 Copilot reached over 30 million paid seats. How sticky is that business?
Look, I think it's only going to get stickier, right? A lot of that maybe a year ago was a lot more experimental and a lot of pilots out there. I think ever since Satya stepped back into like the product side back in November, we've seen meaningfully improved customer feedback to Office Copilot, and I think it's only going to improve from here. And so as you get greater adoption, you get greater usage, you get greater customer feedback, I think the stickiness of that product is going to improve, and it's going to keep customers not locked in, but like, you know, keep customers using the entire Office suite. Whereas that was a worry when Anthropic first announced co-work. Is this going to start to chip away at that? And so far, the answer to that seems no. If anything, you're seeing Microsoft actually integrate co-work as part of the Office suite now.
All right, Rishi, always appreciate you taking time for us. It's interesting to see what they say on that call coming up in just about 30 minutes. Rishi Jaluria over at RBC Capital. Microsoft shares just up about 1%. We do want to turn now to, I guess, right now, in the moment at least, the opposite side of the story, and that's Meta Platforms. Shares have been oscillating, now down about 6.5%, despite a beat on several key metrics in the most recent quarter. Revenue, though, guided at about $61 to $64 billion. The estimate was for $63 billion for the third quarter. But the CapEx numbers, everyone's keeping an eye on, and a lot of people keeping an eye on the free cash flow, which is also at its lowest levels in years. Ygal Arounian joining us right now, Managing Director of Internet Equity Research over at Wedbush Securities. Look, I just want to start off first with the operating side of this business, which is the ad business. Did well, Ygal, and that was expected here. But what's the bridge between the ad business that has made Meta what it is and whatever this sort of world of AI that it's trying to insert itself into?
Yeah, right. So I think that's the problem and why we're seeing the share reaction today. I think the largest factor here on shares post-print is the revenue guidance for 3Q. Now, we saw CapEx move up a little bit on the guidance, but just on the bottom end, and I think probably less than most people expected, less than we expected, especially after we saw the numbers from Google last week. And your question is, I think, exactly the issue is if on the ROIC on that spend and the expectations. Right now, Meta's real only ROIC from the CapEx investment in AI is their ad business. Now they have some other things that are earlier on, like the subscription tiers for Instagram and Facebook, Business AI, which is really centered around WhatsApp, some other features around the rest of the products as well. And things like selling excess compute capacity, a cloud business, custom silicon business. Those are in much earlier stages, if they're even really have started at all. And so that bridge has been more challenging for investors to see. And if the ad business isn't going to come in ahead of expectations, I think that's going to create a challenge here.
I did want to ask you about cash flow. I mean, the expectation it was going to come in negative for the quarter. It came in at $784 million with an M, which is incredibly low for compared to what they had normally been posting in quarters past. Are you concerned at all about that, or is that just something you can look through?
I mean, I think the free cash flow story for Meta and for all the other hyperscalers goes hand in hand with the ROIC story, and investors will be willing to accept the pullback in free cash flow if we're getting negative, obviously only to a certain point. But it's the free cash flow pullback, the CapEx spend, debt and equity raises. Investors will be willing to be patient if they see the story on the ROIC side coming through as well. And again, I think we're not necessarily seeing that this quarter, and we'll wait for the call to get more color on. Perhaps we'll get some insights into CapEx spend for next year, where we are on some of the earlier, if we're making enough progress. So if that tail on the revenue side isn't catching up and we're seeing real pullbacks on free cash flow, then yeah, I think you start to get more concerned. The ROIC is going to catch up, or it needs to catch up. It's not going to happen hand in hand with the spend, but you need to have some visibility in that coming through. And again, I don't think we're seeing that just yet.
What do you make of the after hours trading? The stock down about 6.2%. This is somewhat similar to what we saw with Alphabet. They announced that they were going to be spending more. Shareholders didn't like that too much. Is this just part of that trade?
Yeah, I think that's exactly what it is. Investors trying to digest what's acceptable and who's positioned where. I thought the Alphabet print was actually stronger, right? And you saw the pullback there. Maybe the commentary on the CapEx spend was a little bit more. Google raised the high end of the CapEx spend expectations too, versus Meta just on the low end. But Google had really strong cloud business. They started selling their TPUs, and so they have some of those factors outside of their core search business that are really pushing right now and accelerating. I think for Meta, those factors aren't there yet, and investors need to see more from that.
When we talk about, Ygal, this idea of kind of the product lineup, I mean, there's been a lot of talk about Meta glasses and who knows what else Zuckerberg might be working on behind the scenes. Is there a sort of, and not to mention this, whatever this cloud push that they might actually go for, is there a sense here that Zuckerberg can actually not only grow the company, but more importantly, diversify it away from just being, 90% ads or whatever the percentage is today?
I think that's the goal. On the Meta glasses, again, it's sort of this big picture flywheel of all the factors together. And I think one of the things we didn't talk about is the Muse Spark model, right? And their efforts to push that to be a frontier model at among with the best of them, and building a frontier model. Getting better adoption of Meta AI. Those are also going to be important factors that drive this entire flywheel together. So it's not necessarily the glasses on its own, but I think it's how the glasses, or at least how Zuckerberg's trying to build this, right? How the glasses work with AI and creating a new surface for AI. I think that's how that has to be the plan here for Zuckerberg. I think we're starting to see the early steps of it. The question is how long it takes to play out.
Well, that's what I'm curious about. I mean, the Reality Labs, I mean, they lost, $4.6 or something billion in the most recent quarter. Obviously, that includes the other, virtual reality stuff, including the Meta Ray-Bans and all that. Is this just, you think this could be a business and not just sort of a pet project that, at some point just gets cast aside when Mark decides he wants to do something else?
Well, we've seen that happen before, obviously, with the metaverse. And look, there's been some rationalizations in that part of the business as well. And you've seen some pullbacks in spend, some pullbacks in hiring. You've seen a couple of rifts there. So, I don't think it's free spending all the way forever. But I do think if you listen to what Mark talks about on sort of the future of AI and AI surfaces, I think glasses are expected to be a big part of that. So I wouldn't expect that to be put to the side anytime soon. I think that's a big core focus of how they intend to build out their AI projects.
All right. Appreciate it. Ygal Arounian, Managing Director of Internet Equity Research over at Wedbush Securities. Meta shares continue to be under pressure. We are expecting that earnings conference call. Actually, I do think it just kicked off there at the bottom of the hour there. We're awaiting Microsoft conference call to get underway as well. Meanwhile, let's actually pivot away from tech and into the consumer space, because believe it or not, two of the biggest movers in the after hours trade are basically, restaurants, Chipotle and Starbucks, each up about 7%, beat and raised quarters, and, not just raising, but raising a lot more than what the street was looking for. Abby Roach, Senior Portfolio Analyst over at Allspring Global Investments, joins us right now to talk a little bit more about this. I want to start off first with Starbucks. We had already seen some pretty good momentum with regards to same-store sales growth. The company now saying that you had 7+%, 7.9% in the most recent quarter. They're anticipating 6.5% in the quarter up ahead. It looks like they're slightly nudging up their profitability estimates as well. I know this was a concern that the revenue growth was there, the comp sales growth was there, but would the actual profitability catch up with it? What was your expectation, and did it meet that with this report?
Yeah, thank you for having me. The report certainly met our expectations. I think, we were expecting to see some continued strong comp momentum, and we saw that above and beyond our expectations. But we think too on the profitability side of things, after a couple of quarters of very good top line results from the companies, that we were going to start to need to see the profitability also flow through. And the results this quarter were very good, very happy to see them starting to make some improvements because, as you said, investors really starting to want to see some good improvement there. So this is the first quarter, we hope, of many to come, of them continuing to show some solid execution on the profitability side.
What do you think you get to help? I mean, we should just point out the range 225 to 265 for the full year. So basically keeping the bottom end of the range where it was, the top end of the range goes up, I think 20 cents or so. Give me a sense here of what you think could help get them to a point where they could actually see material improvement over that, because the story so far has been that all of the changes that they're making, they cost money. It's basically, kind of the CapEx spend, but for not AI, but for the consumer facing companies here. Does that ever end? Does that ever get to a point where those costs subside?
We think it's a balance for them. I think they've had to make improvements for the different members who are coming in and getting their cup of coffee to be able to improve the experience for those loyalty members. But we think sort of, through the process over the last couple of years, that experience was lacking when coming to Starbucks. So we think they've been making those investments, improving the coffee houses, improving the menu. They talked a little bit on the little portion of the call that I heard before this about some of the success that they've seen in terms of making transformations there. But we think, it is a bit of a balance, right? And they've been able to drive comp growth. And now we're encouraged to see some progress in terms of them driving the comp growth and then really, trimming the fat where they need to in terms of the P&L, but continuing to see both strong momentum and then, cutting expenses where they need to and being able to use comps to leverage the P&L.
Hey, Abby, I do want to pivot to Chipotle because that stock is also moving higher in the after hours. The company upping its comp restaurant sales growth for the full year. Looks like nothing mentioned about that cyclospora parasite, at least in the earnings results. But do you expect that to come up in the call? Is that going to weigh on their potential outlook for the rest of the year?
I would be surprised if they didn't address it. Obviously, it's been top of mind for investors who have had a bit of indigestion around the restaurant space as a whole, just given this outbreak. But I think, the company obviously has, in the history dealt with foodborne illness outbreaks. So I would be surprised if they didn't mention kind of anything extra that they're doing to be able to help mitigate any risk. But I think in the past, they went through, a long process to be able to help improve safety standards. So I imagine that they will mention it, just given it will be topical with investors. But they seem to be doing a good job navigating the environment.
When we talk about sort of the momentum there on comp stores, I mean, when we had a chance to catch up a few weeks ago with Scott Boatwright, and the discussion, of course, it was a lot about, menu items, whether they were going to continue to do a lot of these sort of limited type of deals. There was a lot of talk about, the honey chicken and a few other things here. Do you think that is sort of the recipe, pun intended, to actually get more people in the store and keep that foot traffic up?
I do. I think, them increasing from 2 LTOs, limited time offerings, to 4 a year, I think drums up that additional excitement for the consumers. I know they've thrown, dips and sauces as well to kind of be able to spice things up for on their menu to be able to get more customers coming back into the restaurants. They've also, revamped from a marketing, from a menu innovation standpoint, and from a loyalty standpoint to help to be able to get customers more excited about coming back to Chipotle. So I think it's really a balance of things kind of across both the menu and the marketing to be able to get that customer coming back and get that traffic continuing to be solid.
All right, Abby, I really appreciate you taking time for us. Abby Roach, Senior Portfolio Analyst over at Allspring Global Investments. That Chipotle conference call kicking off about 10 minutes ago. And just about a few minutes earlier than that, the Starbucks conference call kicked off, of course, with CEO Brian Niccol. And we will catch up with Brian Niccol tomorrow right here on Bloomberg, a one-on-one interview at 9:30 a.m. Eastern time. You don't want to miss that. Meanwhile, some other earnings that came out earlier in the day came from Teva Pharmaceuticals. The shares had a pretty good session, ending higher. This after the drug maker beat its revenue estimates and said it plans to pursue a direct listing on the NYSE. Remember, they trade as ADRs. I had a chance to catch up with Richard Francis, the CEO, just a few minutes ago. Here's what he had to say.
We are very pleased with Q2's results, particularly as you mentioned on the innovative portfolio of Esteta UZEDY, and Ajovy up 43%. So it's great to be able to raise the guidance across all of them. But we believe all of these products have upside, and we talked about Austedo going beyond $3 billion. We talked about UZEDY being part of a $1.5 to $2 billion schizophrenia franchise, and Ajovy being $1 billion. This comes down to we have good products, there's an unmet need in the market, and we're very good at executing through our commercial teams. And I think that's what gives us the confidence that we can continue this trajectory. And also some excitement around our pipeline that when that comes, we know we can maximize those products as well.
On Austedo, which is actually doing great, and you talk about that $3 billion market there, but obviously we know the demand is there. What's the balance right now with regards to some of the pricing issues? You have the new Medicare rules that take effect in January that are going to have a direct impact on Austedo. Do you have enough patient volume or enough potential increase in patient volume to make up for what could be a little bit of a tamp on prices, at least here in the U.S.?
Yeah, absolutely. I think you've summarized it really well there. I think, unfortunately, the majority of patients who suffer from tardive dyskinesia are still not on therapy. So there's a huge patient population we can still help. Now, despite the fact that we're going to have our price come down, we can have the volume go up because of the unmet medical need. The other thing that's happening is the patients we've transitioned to a once a day, and that's allowing patients to get on a more efficacious dose, which also allows them to stay compliant and adherent, which also helps them in a chronic condition to stay controlled. So I think all of those factors give us a clear path to over $3 billion of sales.
One on the Emalax deal, just kind of update us on the Tourette syndrome application with the FDA. Has that's been accepted? And if so, do you have a PDUFA date already on the table that you know of?
Yes, we submitted that in the last quarter, and so if that follows typical timelines, then we should have an approval sometime in Q2, probably towards the end of Q2. And so we're excited about that because Tourette's fits into our sort of wheelhouse. It's neurologists, it's psychiatrists, and so taking some of the learnings that we've had from Austedo and UZEDY, I think we can really make this drug a success. And there's a big unmet need there, as I highlighted on the call. There is only real two treatments for this. One, I would argue, is off-label treatment, and it's less efficacious, but has a safety profile. The other one, an antipsychotic, has efficacy, but has safety and tolerability concerns. So I think a high-efficacy, safe, well-tolerated drug like ecopipam has a real opportunity to help these children. So we're excited, but think of the timelines around about the end of quarter two, which for us is quite nice time because we're launching olanzapine, our long-acting treatment for schizophrenia, in Q4 this year. So that gives us a bit of a gap before we start launching the next product.
And you're confident that you'll be able to do that by the end of this year? The FDA and some of these issues with regards to the monitoring requirements and the labeling, has that been sorted out, or you're confident it will be sorted out?
Well, we've submitted to the FDA. We're in sort of the typical negotiations or discussions with them and submitting the data. I think the data is very comprehensive. So I think our phase 3 study was constructed and put together with the FDA's feedback in mind. So I think we've done what they asked. I think the data is pretty compelling. So I think we're on a clear path. But that said, we've got to follow the process, and we're halfway through the process, so let's see how this plays out. But we're fully prepared for launch Q4, and we're very excited about it.
Hey, and before I let you go, Rich, I just have to ask you about the change with regards to your American depository shares and doing a more direct, ordinary listing here. Is that designed, to drop your cost of capital, increase liquidity? Why make this change?
Well, I think it's something which we've heard that people want. I think it opens up a lot of opportunity for investors in the US to invest in Teva. And so, once again, we listen to investors, we listen to the market a lot, and that's something that has been suggested. And so we want to give more people the opportunity to invest in Teva, and I think this is a step to do that.
Our thanks to Teva Pharmaceutical CEO Richard Francis. And a lot more earnings coverage coming up. In the meantime, check out our Bloomberg Newsmaker event on LiveGo. Bloomberg's Randall Williams has just been speaking with the president of the Washington Commanders. He's our Business of Sports reporter. And this is Bloomberg.
What other ways will the Commanders invest in the city, the neighborhoods around the stadium, the youth coming up in terms of sports development?
Well, ARM and Qualcomm are also joining this afternoon's earning parade. Shares of ARM in the after hours down not that much, but 0.6%. Qualcomm, a bigger mover here, down about 3.5% in the post-market. Joining us live to break all this down, Jay Goldberg, Senior Analyst of Semiconductors and Electronics at Seaport Research Partners, who covers both companies. Let's start with Qualcomm here. It was a bigger miss, a bigger move in the stock. Give us your reaction to just how this company is going to survive in an era of weaker demand for phones.
I think that's a big question for Qualcomm. The story, if you go back a little bit, the story around Qualcomm for the last couple of years has been, how are they going to diversify their product revenue to get into other areas beyond mobile? And as of today, they're still pretty reliant on mobile, but the focus has really much been on cars and IoT and now data center. And I have to think that these quarters make me concerned that they have taken their eye off the core business. Mobile's a really challenging market right now. Memory is, of course, a big problem. It's eating into demand. But I look at these numbers and I think there's something else going on. They're talking about losing even more share at Apple. I think they've taken their eye off the ball on mobile.
Yeah, I did want to ask about that because the company did warn it's losing business from Apple more rapidly than anticipated. So is this about them needing to find new customers for that mobile chip business or just diversify more broadly?
I think that's the root of the problem on mobile is that they are, they told us, a couple years ago they were going to lose Apple by 2027, and now it looks like they're going to be out of Apple entirely by the end of this year. So that's not good. So they've needed to diversify their customer base in mobile. The problem is in mobile, all of their customers are also working on their own chips that are alternatives to Qualcomm, and that's they're competing against their own customers. And the new businesses, the other areas that I mentioned, those are coming online mostly, but it's going to take them a long time. And I think their ability to succeed in some of those markets is still really unproven.
With regards to this transition, and I just want to go back to just particularly in the handset market. I mean, they did seem to articulate that they think that they've seen a particular bottom right now. And we should point out that conference call just now getting underway. But it gets to this idea, is the issues right now in the smartphone market overall, not just with Qualcomm, is that purely a function of the component pricing, or is there just maybe a demand cycle issue as well?
I think it's a little bit of both. Like, I mean, pretty much everybody in the world who's going to buy a smartphone has one right now. And so the market growth is entirely determined by replacement cycles. And I don't think there's a really compelling reason to buy a new phone right now. I think that changes later in the year. I think we'll get new exciting phones from Apple that will sort of get things going a little bit. But right now, the market's not particularly exciting. And on top of that, prices are getting more expensive because of memory. And so you go buy a new phone today and it might not be as good as the phone you got last year. So why upgrade?
So draw a distinction between what we're seeing with Qualcomm and what we're seeing with ARM, because I mean, ARM's still a company that gets most of its revenue from royalties tied to how many handsets are sold. Their shares are slightly weaker here, but not necessarily to the extreme. Is ARM a completely different story when we talk about what's been going on in the chip design space compared to Qualcomm?
I think so. ARM has done a much better job of diversifying. They have a much more flexible business model because they're licensing IP. That lets them move more nimbly. So they've gotten much better traction in automotive and industrial. And then I think they have a much more credible data center story than Qualcomm does. Qualcomm has been trying to get in the data center for a decade now. This is their third or fourth attempt, depending on how you want to count. And they put out some big numbers last month about what they hope to do in the data center. I don't think they have as much credibility as ARM does. ARM has been working away at the data center for much longer and has, I think, a more credible, sort of persuasive, bigger story.
How long can that data center story persist? I mean, you look at the shares of ARM, the ADRs, they're already up like 100%, even more than that year to date. Data centers are it's a super hot theme right now. You have to wonder, does that momentum kind of die down?
So the issue with ARM stock is that it has a very, very thin float. Its effective free float is in the single-digit percentage of shares. Right, SoftBank still owns 75% of it, and that does weird things to the stock. If you look at its movement over the last 3 months, it's gone from $150 up to $420. Now it's down in the mid 200s on basically no news. Right, that's not fundamentals. That's trading. That's a lot of sentiment and also this weird share price liquidity dynamic. So I think ARM is an important company. It has a really critical central role to the entire semiconductor industry. They're doing very well at in the data center, the hot area. And I think that will continue. They'll continue to do well there.
All right, Jay, always appreciate you taking time. Jay Goldberg, Senior Analyst of Semiconductors and Electronics over at Seaport Research. That ARM conference call, Emily, does kick off at the top of the hour. The Qualcomm conference call ongoing right now, and the first headline out of that is that Qualcomm does see top-line growth next fiscal year. Cristiano Amon, the CEO of Qualcomm, he'll be joining us on Bloomberg Television tomorrow, I believe in the 11 a.m. hour Eastern time.
There's a lot going on, Romaine, tomorrow. Let's look ahead, though, to what...
Hang on one second, because I just want to, just make sure, too, like we didn't really get to some of the other earnings out there as well. Robinhood shares are down, despite actually beating on most of the main metrics that folks are looking for. But when it comes to expenses and their guidance going forward, maybe not quite what everyone was looking for. We're going to have the CEO, Vlad Tenev, on the close tomorrow afternoon to talk a little bit more about what we saw in those earnings. And, of course, we're going to talk to Brian Nichols tomorrow. Brian Nichols, Starbucks just on fire, in fact, setting up for what could be one of its best earnings day, post-earnings day performances in a while after that 8% jump we saw 3 months ago.
A good read on the consumer. We have pretty much a beat here from both Chipotle and Starbucks, and those shares reacting in the after hours. There's been a lot of fear about consumer sentiment declining, and are people actually going out and buying burrito bowls and $8 lattes? The answer is yes right now. Well, we are going to get another read on the consumer tomorrow on a couple of different levels. I do want to jump ahead just for a second here because we're going to hear from MasterCard. We're going to hear from Hyatt, Norwegian Cruise, Yum Brands, Hershey, Canada Goose. Are people still buying Canada Goose? It's hard to think about wearing a Canada Goose right now when it's like 90 degrees Fahrenheit in New York. But so we get all those earnings. We're also going to get the PCE numbers, which everyone's focused on the inflation numbers out of there, but also we get personal spending and income, which is also going to be an interesting tell as well. And we can't forget, we have been jumping around, but there are still some hyperscaler earnings coming up, tech earnings, Amazon, Apple, Coinbase, Roblox, Reddit, and Samsung all coming through. And we talk about this idea here of what we learned over the last few sessions, of course, with the hyperscalers today, and of course, what we learned with Alphabet a few days back here. Does Amazon become a different story than what we heard from Microsoft with regards to their cloud business, or from Alphabet? Apple, a totally different ballgame, one of the best performing tech stocks over the last couple of months. Right. They kind of held back a little bit on that AI strategy and then came in a little bit later, and it's been paying off right now. And we will have full coverage of those Apple and Amazon results tomorrow, right here on The Close, right here on Bloomberg.